Hi guys, welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about how to pick stock and invest properly. So make sure to watch the full video. Picking stocks is an intimidating process. There are 11 different stock market sectors, 69 distinct industries, more than 8,400 securities, and more than 4,000 listed companies across the major U.S. exchanges. How on earth can anyone, let alone a beginner, go about intelligently choosing specific stocks that are primed to do well? Right off the bat, investors should know that there's no foolproof algorithm or formula that will ensure success. As many stocks as there are thousands more investing philosophies, schemes, strategies, and mindsets that investors use to approach the market. As a newer investor, or even as an experienced market participant, re-examining your own approach, it's helpful to understand the following principles. Here are some things you should know before picking stocks. Know you're betting on yourself. Before you start devising your plan to become the next Warren Buffett, it's absolutely vital that you understand the game you're playing and what the odds are. By opting to pick individual stocks, you're betting on your ability to beat the market and exceed the return of the stock market at large. This is extremely difficult to do. 84% of professional fund managers, whose entire job is to beat the index, fail to outperform their benchmarks after a 5-year period. After a 15-year period, more than 89% of managers fail at that task, according to the SPIVA US scorecard, a study by S&P Global. Individual investors face even bigger hurdles to success, and not just because they don't have the luxury of dedicating their entire working life to studying investments. Psychological mishaps, like buying when stocks are on a run and selling when they're down, as well as overtrading, are largely to blame for the miserable actualized returns of everyday investors. So while this principle is arguably the least satisfying of the 7, it's also the most fundamentally important. By choosing to pick stocks and not buying a low-cost index fund, like the Vanguard 500 Index Fund, ticker VOO, that automatically earns you market returns, you're engaging in a bit of hubris and choosing to go against the odds. Know your goals. If you still wish to pick your own stocks despite the odds, the next step is to outline your goals. Are you a young, swing-for-the-fences investor who wants to amass a multi-million-dollar stock portfolio by the time you're 40? Congratulations! You've just narrowed your universe down to high-risk, high-reward names, likely out-and-out growth stocks or beaten-down contrarian names. Do you have a shorter runway and simply desire to play it safe and maybe earn a little income while you're at it? You'll likely only want to consider blue-chip companies and dividend stocks. You may find some ideal portfolio pieces among real estate investment trusts or dividend aristocrats. Don't invest in businesses you don't understand. A stock is nothing more than an ownership stake in a business. If you are investing in a local small business, would you want to put your money behind it without looking at its books and understanding its revenue, costs, seasonality, opportunities, risks, competition, and advantages? Doubtful. Good stock picking requires the same diligence and understanding, a concept oft repeated by investing greats over time. Warren Buffett has preached this for decades, while Peter Lynch, the famed former manager of the Fidelity Magellan Fund, cautioned to never invest in any idea you can't illustrate with a crayon. Each company comes with its own strengths and risks. For instance, large multinational corporations with established supply chains and roots in the global economy typically have less risk than startups or initial public offerings or IPOs, since they're better situated to weather market storms, says Dan Cronin, founder and wealth advisor at Lifestyle Wealth Management. Understand financial ratios. Of course, once you know your goals and come across a good business that you understand, the search doesn't end there. You need to have some idea about whether the stock itself is cheap or expensive. This is where financial ratios, derived from the market value of the stock and various numbers from the balance sheet, income statement, and cash flow statement, come in handy. Valuation metrics like price earnings, price sales, and price book are some well-known examples, but other metrics can help convey how well a company can pay its debts, how profitable operations are, and how efficient it is. While it's not necessary to scrutinize every last financial ratio before investing in a company, you should know where the important ones stand in relation to peers and know which way they're trending. If it's too good to be true, it probably is. This ancient aphorism holds true in the stock market, where many deceptive temptations can await investors. One common mistake newer investors can make is to be drawn in by stocks with attractive seeming valuation metrics, most commonly the price-earnings ratio, or P/E ratio. Cyclical companies like home builders, automakers, and banks may on occasion sport P/E ratios much lower than the rest of the market, making them appear cheap. But just because you see companies trading for single-digit P/E ratios doesn't mean these stocks are oversold. In fact, the market may be signaling that the peak of the earnings cycle is in the rearview mirror, and trailing earnings are much higher than one can expect moving forward. These kinds of seemingly cheap stocks are known as value traps. Assess the moat, especially if you want to set it and forget it portfolio. You'll want to pick stocks of companies that have long-term competitive advantages, distinguishing them from the broader market. Warren Buffett refers to these perks as moats that protect the corporate castle. In essence, wide economic moats help ensure that companies continue to thrive and protect margins in the long term. Moats for Coca-Cola Co. (KO) include its globally recognized brand and its distribution network. For instance, Apple Incorporated (AAPL) also has an enviable global brand, network effects that make its products more useful as more people use them, and high switching costs because users would be forced to adapt new software and buy new compatible accessories if they switch to a competitor. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.